Okay, dear ATX students, let's discuss the last tax reducer investment, which is VCT, Venture Capital Trust. Previous two tax reducer investment, which we have already discussed, one is EIS and another is SEIS. Both of the previous tax reducer investment, they had a number of things common, but one of them was both were private companies. Obviously, it is very difficult for the private companies to gain the confidence of the investors. So obviously, it is difficult for them to raise the finance. When it comes to VCT, Venture Capital Trust, there's good part in VCT is VCT is a listed company. So the good part in VCT is, which is a venture capital trust, it is a listed company, which means they have the access to the wider pool of finance. They can easily raise the finance. It will be easy for the investors who is having shares in VCT, they can easily sell it. So as far as VCT is concerned, the good part is that they are a listed company, but there's a risk as well. What VCT does, they basically raise finance, obviously from the investor, but they reinvest in EIS or SEIS shares. That is something I would say a riskier part. Let's see if someone is investing in VCT, what benefit they can get. Relief for investment in venture capital trust was introduced to encourage individuals to provide capital for unquoted trading companies. But VCT is a quoted company that buys shares in EIS shares, and so an individual is able to spread. Okay, they only buy shares in EIS shares, not SEIS. Okay, so they are getting funds from the investor, but they are investing in EIS shares. Tax consequences. What are the tax consequences? If someone makes investment in VCT, what benefit they can get? Income tax relief is 30% cost of, just a minute. Income tax relief is 30% cost of the shares subscribed, but the maximum investment which you can do in VCT is 200,000 per tax year. So the maximum income tax relief is 60,000. Again, the same thing. This income tax relief of 60,000 can reduce investors' income tax liability to zero. It cannot create a refundable. Deduct from the individual's income tax liability can reduce liability to nil, but cannot create a tax repayment. No carryback facility is available in EIS and SEIS. They both give you the carryback facility, but VCT does not give you a carryback facility. Claim is a little bit earlier. For 25-26, the claim date is 5th April 2030. Dividend income from VCT exempt from income tax for investment up to whatever dividend you are getting from VCT, it is exempt. Whatever dividend income you are getting from venture capital trust, it is exempt, which is another, I would say, encouraging part. Capital gain tax. Capital gains on the disposal of shares in VCT are exempt. Investment up to wow. Simply when you are selling VCT shares, whatever the capital gain is coming, it is exempt. But you will not be getting any relief for the capital losses. Previously, when we were selling EIS, SEIS shares, after a certain time period, let's say after 3 years, so the gain was exempt, but in case of loss was allowable to you. But here, in case of VCT, you are selling shares, whatever the capital gain comes, it is exempt, but even the capital loss comes, you will not get a capital loss. Capital loss is not allowable here in case of VCT. So if you're selling VCT shares, simply the gain is exempt. If the loss comes, you have to ignore that loss. Okay. There's no DAFRA relief. You are not getting any DAFRA relief. It is not like that. I have sold a chargeable asset. There's a capital gain on that chargeable asset, and sale proceed. I have invested in VCT. So will I get any deferred gain on the chargeable asset which I sold first? So there's no such deferred relief. Okay. Inheritance tax shares in a VCT do not qualify for business property relief. Withdrawal of VCT. Now this is important. Income tax relief is withdrawn if the shares are not held for a minimum period of 5 years as follows. So in case of VCT, obviously there's only income tax relief. You're not getting any capital gain relief. So your income tax relief will be withdrawn if you're selling within 5 years. It means you want your income tax relief in case of investment in VCT, not to withdraw. You have to keep your investment for at least 5 years. Again, if it is not an arm's length transaction, you have given your VCT shares at any price to your sibling. So if it is not an arm's length transaction, means not at fair value, the entire income tax relief will be withdrawn. But if the transaction is at fair value, you sold to your friend, but you sold it at a fair value, then income tax relief withdrawn will be original IT relief given, and 30% proceed, 30% of the sale proceed. If it's a fair value transaction, but you have sold within 5 years, so your income tax relief will be withdrawn, and that will be lower of original income tax relief given, and 30% of the sale proceed. Now here, students, we are having a comparison of these three, I would say, tax reducer investments. Level of risk, enterprise investment, EIS, SES, they both have a high risk. Only one company invested in. VCT, not as high. Risk is spread over number of investments. Qualifying individual, you need to subscribe in cash, new ordinary shares. Qualifying company, you should be having holding less than equal to 30%. VCT, subscribe, new issued. You should not be an employee or director of a company, independent of the company prior to first issue. Not current employee, but you could be a former employee or director of the company. In VCT, there is no such thing at all. Maximum investment in EIS is 1 million. It is 200,000, 200,000. IT relief withdrawn if you are selling within 3 years. Here, IT relief will be withdrawn if you are selling within 5 years. IT relief, income tax relief is 30% of amount subscribed. Here it is 50%. Here it is 30%. Carryback facility. First, both tax reduction investment, they give you carryback facility. VCT does not give you carryback facility. In first two investment, if you are getting dividend income from EIS or SEIS, your dividend income is taxable. If you're getting dividend income from VCT, it is exempt. So this comparison actually makes the things a little bit more interesting, I would say. And plus, it makes easier for the student to remember, I would say, the main differences. In this way, you can also, I would say, remember the rules of individual tax reducer investment as well. Then disposal, enterprise investment scheme and seed enterprise. If you're selling after 3 years, exempt. But if you're selling at a loss, loss is allowable. In fact, you can claim your loss treated like a trading loss. Here, when you are selling VCT shares, so whatever the gain comes or loss comes, it's not allowable. CGT relief, gain on chargeable asset deferred. Here, for example, Mr. Y has sold a chargeable asset and sale proceed. He has invested in EIS, so whatever the gain came, he is going to get deferred. The sum of the part of the gain would be deferred. In SEIS, if you recall, the sum of the part of your capital gain gets exempted, but in VCT, there's no such facility at all. For BPR, first two, you need to have an ownership period of at least 2 years. The last one does not qualify for BPR. The topic of BPR you will be able to 100% understand once you will go for IHT. And I said earlier also, I'm announcing it again because immediately after this, you will have IHT lectures. Inheritance tax topic is 110% same in the previous Finance Act and in the current Finance Act. There's no change at all. Okay, let's attempt this comprehensive example. Before we attempt this comprehensive example, there are one or two things which you need to learn, but there's no need to go into too much detail of those things, which I'm just giving you the idea here. They are asking us to calculate income tax liability for the tax year 25-26. Matthew has the following investment income in addition to the trading income is 90. Dividend from VCT is 3,000. We have just discussed. Either you are getting a dividend income or you're selling VCT shares, it is exempt. Dividend from a real estate investment trust. Now here you need to learn only one point. For that one point, there's no need to go for book reading. If you are getting a dividend from real estate investment trust, actually real estate investment trust, what do? Let's say they issue shares, investor, they buy the shares, and then real estate investment trust, After collecting the money, they put into the properties, and normally they will give those properties on rent. So they generate a rental income, and then that rental income in the form of dividend is distributed to the investors, to the shareholders. Right now, student, you just need to know one thing. Number one, whatever amount is, whatever dividend is coming from real estate investment trust, it is 20% net of tax. Now, what do you mean by 20% net of tax? 20% net of tax means if I'm the investor in real estate investment trust, whatever dividend I'm getting from real estate investment trust, it is 80%. Logically, 20% tax I've already paid in advance. Second point, you need to know, whatever the dividend is coming from a real estate investment trust, you have to treat that real estate investment trust dividend as a property income, as a non-saving income. I've given you the logic behind that. So simply, whatever comes to you from real estate investment trust, it is actually 80%. While solving the question, we have to gross it up. How do we gross? Simply multiply by 100 divided by 80. But don't forget one thing, whatever is coming from real estate investment trust, even the question categorically says dividend, you will have to treat this like a property income, which is a non-saving income. 4992 multiplied by 100 upon 80, I'm getting 6240. Don't worry, then I'll show you the proper presentation as well. This 6240 will take it as a property income, non-saving income. Dividend from interest in possession trust. For here, students, number one, the dividend is dividend. For interest in possession trust, you need to know one thing. Whatever the dividend is coming from interest in possession trust, it is net of 8.75% tax. Logically, if it is net of 8.75% tax, means whatever we are getting as dividend from interest in possession trust, it is 91.25%. How did I get this 91.25%? If I have paid 8.75% tax, from 100%, if you deduct 8.75, you will left with 91.25. So students, for dividend from interest in possession trust in ATX, you just need to know one thing. Whatever dividend you have received from IIP, yes, it is a dividend, but it is net of 8.75% tax, means 8.75% tax you have already paid. Again, when we'll solve this, you have to gross it up, means bring it to 100%. Multiply by 100 divided by 91.25. So this dividend is dividend 2205 multiplied by 100 upon 91.25. I'm getting 2416. Discretionary trust income. Number one, whatever from discretionary trust comes, it is net of 45% tax. Discretionary trust income, whatever is coming, it is net of 45% tax. It means the amount which you are receiving from discretionary trust, it is 55%. Why it is 55? Because you have paid 45% as tax. Next point which you need to know is discretionary trust income is treated, you have to treat this as a non-saving income. Repeat, whatever income we are getting from discretionary trust, it is net of 45% income tax. Means we have already paid a 45% income tax, we are receiving only 55. And income from discretionary trust is treated as a non-saving income. So let's do it. You have to gross it up while solving. So 100 upon 55, because whatever I have received, it is net of 45% tax. It means I have received 55. So we are bringing 55% value to the 100% value. 3,300 multiplied by 100 divided by 55. I'm getting 6,000. Bank interest is obviously bank interest. No need to do anything. In fact, if you look at 458, and this is the only saving income which we have in this question. So this will be easily covered in, I would say, nil rate band. By looking at the data, we can easily say this individual is a higher rate taxpayer. Whoever is a higher rate taxpayer gets nil rate band for the saving income 500. Both trust assets comprise of quota shares only. He also invested 50,000 in a qualifying enterprise investment scheme. So 30% of 50,000 will reduce your income tax liability during the tax year. He has paid personal pension contribution during the period 13,250. We have already discussed one thing, student. Whenever someone has contributed into personal pension scheme and nothing is mentioned, it is net, it is 80%. You have to gross it up, 100 upon 80. because basic and high rate band will increase by the gross PPC plus adjusted net income will reduce by gross PPC. 13,260 multiplied by 100 upon 80. Students, I'm getting 16,575. So basically, your basic and high rate band, they will increase by 16,575. Let us quickly first check one more thing, adjusted net income, because if Matthew is having, let's say, adjusted net income more than 1 lakh, then entire personal allowance 12,570 will not be available to Matthew. But if its adjusted net income turn out to be less than 1 lakh or equal to 1 lakh, then Matthew will get the entire personal allowance. So I just want to show you quickly the net income. Just do the total of all of Matthew's income. 90,000 plus 6240 plus 2416 plus 6,000 plus 458. Students, I'm getting net income 105114. That is the net income less the gross PPC. Gross personal pension contribution, we have just calculated 16,575. So obviously Matthew will get the entire personal allowance. Why Matthew will get? I'm getting 88,539 adjusted net income. Obviously the Matthew is having ANI less than 1 lakh. So Matthew is entitled to get the entire personal allowance, which is 12,570. And we know that when we calculate income tax liability, first we deduct personal allowance from the non-saving income. Just to save the time, I'm just making the columns. I'll show you the proper presentation done by the Kaplan people as well. Don't worry at all. Non-saving income, saving income and dividend income. Let's make a total. We are having trading income 90,000. Trading income is 90. Okay. VCT, exempt real estate investment trust, whatever the dividend is coming, income which is coming from real estate investment trust, we have to gross it up and we will treat this like a property income. So I'll show in under the column of non-saving. It is 6240. It is 6240. Okay. Income which is coming from interest in possession trust, that dividend is dividend, and after grossing it up, it is 2416. Dividend from interest in possession trust, which is 2416. Okay. Discretionary trust, income from discretionary trust. It is treated as a non-saving income, which is 6,000. Okay. And bank interest is obviously bank interest. Simply your saving income. Bank interest is how much? 458. So very easily we can calculate the total income. Let's calculate the total income of each column. 90,000 plus 9240 plus 90,000 plus 6240 plus 6,000. Students, I'm getting 102240 458, and here we'll get 2416. I'm getting 105114. We have already discussed one point, students don't forget. Matthew's adjusted net income is less than 1 lakh. That is why Matthew is entitled to get entire personal allowance. Let me change the color for you. Personal allowance. 12,570. Now that will give us taxable income. Taxable income. 1,02,240 minus 12,570. 89,670. 458. 2416. 92,544. Obviously, when we apply income tax, so first we apply income tax on non-saving income, then saving, finally we go for dividend. Income tax. Now, student, basic rate band will not be 37,700. It will increase by the gross PPC. Gross PPC 16,575. So plus 37,700. 16,575 plus 37,700. I'm getting, students, 54,275. So logically, now the limit of the basic rate band is not 37,700 for Matthew. It is actually due to gross PPC 54,275. Question: why we are not increasing a high rate band limit? Obviously, we know that by the gross PPC amount, your high rate band limit will also increases, but there's no need to increase that high rate band limit and to show your examiner, because whatever income Matthew is having, the remaining income is very easily going to be adjusted in a higher rate band. Otherwise, you still want to show, you can do that. There's no issue at all. It was non-saving 50. 37,700, 16,575. It was 54,275. Applicable rate is obviously 20%. I'm getting 10,855. Now let's say insurance. Total taxable income in the column of non-saving is 89,670. From this 89,670, we'll deduct 54,275. Whatever the remaining taxable income comes, that falls in higher rate band, where applicable rate is 40%. So 89,670 minus 54,275. I'm getting 35,395 into obviously 40%. 14,158. So basically, we have taxed this non-saving income. 89,670. Now, if you look at this individual, obviously this individual is a high rate taxpayer. Whoever is a high rate taxpayer gets nil rate band 500 for the saving income. So saving nil rate band, entire 458 is covered in this nil rate band. Now, let's talk about the dividend income. Every individual, irrespective of their tax paying status, gets nil rate band of 500. So dividend nil rate band is 500 into 0% is obviously 0. Now, of course, the remaining dividend income falls in higher rate band, where applicable income tax rate is 33.75%. Student, the dividend income is 2416. Gross dividend income is 2416 minus the 500 nil rate band. I'm getting 1916. The dividend income falls in high rate band. Applicable rate is 33.75%. I'm getting 646.65, so make it 647. This will give us the income tax liability. But obviously this liability is before the EIS relief. 10855 plus 14158 plus 647. Students, I'm getting 25,660. Now let us deduct EIS relief, which is actually 30% of the investment. So investment was, how much was the investment? He also 50,000. So let's take 30% of this, which is 15,000. Okay, here comes the income. Tax liability. 10,660. They have asked us to calculate just a minute. They've asked us to calculate income tax liability. Calculate income tax liability, we have calculated. Now listen to me carefully. Of course, for the sake of this question, you have to stop at 10,660 because the question says calculate income tax liability, which we have calculated. But there is one question. The question is, sir, so many incomes we have received net of tax. Means we have already paid the tax. What about that? Let me answer. Your question is asking you to calculate income tax liability. So the income tax liability is 10,660. What if, let's add one more thing. And right now what I'm telling, this is not asked by the question. For example, there was one more requirement that also calculate income tax payable. This is your liability, agreed. Now examiner says let's calculate income tax payable as well. If I need to calculate income tax payable as well, then I'm going to deduct all the tax which I've already paid. What I'm going to do, let's see. You will be getting a tax credit because we have already paid the tax. Come here. Real estate investment trust. Actually, we have received 4,992. But in our calculation, when we were calculating income tax liability, we included 6240. So the question is, where is the difference? Matthew has actually received 4,992. But while calculating the income tax liability, we included 6240. So the difference of 6240 minus 4,992, which is 1248. This can be calculated if you take 6240, 20% of this. Definitely, it has to be the same result, 1248. Actually, 1248 is the income tax which we have already paid on the dividend income which we receive from real estate investment trust, which means that real estate investment trust, okay, again I'm telling you the step which I'm right now doing it for you just for the sake of your understanding. It is not a ask in the question. Okay, less tax paid on real estate investment trust income. It is 6240, 20% of that, 1248. This is the tax which we have already paid. Okay, there are more. From IIP, student, if you look at this IIP, from dividend which we have received from IIP is, it is 2205. But in our calculation, we included 2416. We included 2416, we received 2205. So how much we have already paid as tax? 211. 211 we have already paid as tax, which is 8.75%. Tax paid on dividend from IIP. 2416, it is 8.75% which we have paid. 211, let me double check. Yes, it is 211.4. Forget that 0.4, 211. Come here. Discretionary trust. A student from the discretionary trust, actually, Matthew, oh, just a minute. Just a minute. Let me pause the video. Okay, student, I was just telling from discretionary trust, Matthew has actually received 3,300. But after grossing it up, we made it 6,000. So the question is, from discretionary trust, Matthew is receiving 3,000. Actually, he has received 3,300, but we included 6,000 by doing that amount. We grossed up that amount. Basically, on discretionary trust, he has already paid 45% income tax. So let's deduct that as well. 45% of 6,000. Tax paid on income from discretionary trust. 6,000. Let's take 45% of that. 6,000, 45% of that. I'm getting 2,700. So here comes your income tax payable, but let me repeat again, it is not the part of answer. We are just doing one step additional. Tax payable. Because logically, Matthew has already paid 1, 2, 4, 8, 2, 11, and 2,700. 10,660 minus 1, 2, 4, 8 minus 2, 11 minus 2,700. So logically, the tax payable is only 6,501. I think there is no more income on which he has already paid tax. We have considered all of them. We have taken the tax impact on real estate investment trust, IIP, discretionary trust. Let me show you what Kaplan people have done it, so that will give you the more understanding. Is here. You can see this is what Kaplan people have done it. Taxable income, I believe we got the same result, 92,544. Great. Income tax liability. Students, you can check that income tax liability, we also got the same answer, 25,660. And then after deducting EIS relief, the final answer of income tax liability is 10,660. They did not deducted what we were doing it. Why? Because question did not ask us to calculate tax payable. So students, here we have completed now your tax reducer all investments. There are three tax reducer investment. One is AIS, another is SEIS, and I would say shortest one is VCT, Venture Capital Trust. So thank you very much for watching this lecture. Hope to see you and others in the coming classes. Now we'll be starting from the next class, IHT topic. Thank you.